Hello students, in present video I am going to explain about problem number 11 from depreciation lesson. I am taking this question from Intermediate Telangana State Telugu Academy second year accountancy textbook. With the help of this video, I am going to explain about second method of depreciation calculation, that is diminishing balance method. In this video, you are going to learn about the meaning, advantages, disadvantages of diminishing balance method and for which type of assets diminishing balance method of depreciation is suitable. I made 12 videos on depreciation topic. Video links I am providing in the description box. Let us see the question. Madhu and company purchased a machine on 1st April 2017 for 20,000 rupees. Asset name is machine. They bought it on 1st April 2017. Cost of the asset is 20,000. Depreciation is charged at 10% under diminishing balance method. First 10 problems belong to fixed installment method. Here, diminishing balance method, a new method of depreciation calculation is given. At the rate of 10% per annum, under diminishing balance method, we have to provide the depreciation. Diminishing balance method is also known as written down value method or reducing balance method or declining balance method. Any word he may use in the public exam. The company prepares accounts at the end of the financial year. Company is following financial year as their accounting year. So year starts from 1st April and ends with 31st March. Prepare machine account for 3 years. First I will explain how to prepare the machinery account. Then we will see the meaning, advantages, disadvantages and suitability of diminishing balance method. Let us solve this problem first. They purchased this asset on 1st April 17. No? Therefore, we should prepare asset account from 1st April 17. If this is the starting date of the year, then year ending date is count 12 months from this date, then date falls on 31st March 18. This is first year. Then immediate next date is 1st April 2018. Then second year ending date is 31st March 19. Third year, immediate next date of this date, 1st April 19 to 31st March 20. For 3 years, he is asking us to show the asset account. So up to 31st March 2020, we should prepare the asset account. So in asset account, when they purchase any asset, debit side we should write no to bank, purchasing date, cost of the asset. Now every year depreciation is to be provided at the end of that year. No, so last date of first year is 31st March 18. Depreciation is to be credited by depreciation. On cost of the asset we should provide the depreciation. Asset is purchased for 20,000. Therefore, 20,000 into 10%. If you cancel the zeros, then depreciation amount is 2,000 rupees. Then find out the balance carried out. Debit total 20,000 minus credit total 2,000. Balance carried down is 18,000. For balance carried down also write down the last date of first year. So in first year, there is no difference between fixed installment method and diminishing balance method. Now come to second year. Second year starting date is next immediate date of this date. 1st April 18, bring the balance to balance brought down 18,000 rupees. Second year last day 31st March 19. On that day we have to provide the depreciation. Now new point comes. If it is fixed installment method of depreciation, then in second year also on original cost of the asset we have to calculate the depreciation. So same 2000 we used to take for second year and even for third year. So the main feature of fixed installment method is every year depreciation is to be calculated on original cost of the asset. But this is diminishing balance method. The feature of this method is every year we should calculate the depreciation on opening balance of the asset. The balance of the asset on starting date of the year. For first year, opening date is 1/4/17. On that day, we have 20,000 worth asset with us. So opening balance of the asset is 20,000. Cost is also 20,000. That is why in first year there is no difference between fixed installment method and diminishing balance method. But come to second year, original cost of the asset is 20,000, but opening balance of the asset on starting date of second year is 18,000. In diminishing balance method, on 18,000 we should provide the depreciation. So credit side, again we have to show the depreciation calculation. In fixed installment method, we used to take 2,000 directly. So calculation is not required because in first year already we have shown that calculation. But in diminishing balance method, as same amount I am not taking, as I am calculating depreciation on opening balance of the asset, every year we have to show the depreciation calculation. One numerator, one denominator. If you cancel, then depreciation in second year is 1800. Then find out the balance carried out. Debit total 18,000 minus credit total 1800. 16,200 is balance carried down. Write down on credit side and put the total 18,000. Now come to third year. Date is next immediate date of this date. 1st April 19, bring the balance. Balance brought down 16,200. In third year, we use that asset till the end, no? So on 31st March 20, we should provide the depreciation. For third year, how much is the opening balance of the asset? 16,200. Therefore, on that value, we should calculate depreciation 10%. Depreciation for third year is 1620. Then find out the balance carried out. Debit total 16,200 minus credit total 1620. 14,580 is balance carried down. Total is 16,200. Asset is not sold. That is why there is balance carried down in third year. As there is balance carried down, asset account continues. Therefore, for next year, bring the balance and leave the problem. Because he asked this account only for 3 years. 1, 2, 3. As a student, only for 3 years you are preparing this account. When you work in any organization, till the end of its useful life, we have to prepare the asset account. Observe the name of this method, diminishing balance method. Diminishing means reducing, decreasing, declining. Once you observe the depreciation amounts, depreciation amounts are not same. Year after year, depreciation amounts are decreasing. Why? Because every year depreciation is calculated on opening balance of the asset. Observe the opening balances. First year opening balance is 20,000. In second year, opening balance is reduced. Why? Because in first year we use that asset for 12 months, 2,000 value is reduced. Now for second year, asset value became 18,000. Asset opening balance is diminished, reduced. Similarly, in second year we used it for 12 months. 1800 is reduced from 18,000. Then for third year, asset opening balance became 16,200. So on diminishing values, we are providing depreciation every year. That is why this method is known as diminishing balance method or reducing balance method or declining balance method. Three names give the same meaning. That is, every year on decreasing opening balances, we are calculating depreciation. Other name of this method is written down value method. Why this name is used? Written down value means opening balance or book value. Once you recollect previous problems, in sales model, we used to calculate profit or loss on sale of asset. Then procedure is cost minus total depreciation. Then book value comes. Book value is also known as written down value. We used to compare this written down value with the sale value to know the profit or loss on sale of asset. So written down value means the cost of the asset minus depreciation up to the previous accounting year. For example, come to second year. For second year, previous year is first year. First year depreciation is 2000. Cost of the asset 20,000. From 20,000, when previous year 2017-18 year depreciation 2000, when it is removed, then the book value of the asset is 18,000. This 18,000 is also known as written down value. On written down value, we calculated depreciation. Come to third year. For third year, previous years are second year and first year. First year depreciation 2000, second year depreciation 1800. Total depreciation 3800. From 20,000, when you deduct 3800, then the written down value of the asset is 16,200. On that value, we provided depreciation now. Thus, every year we provide depreciation on book values, on written down values. That is why this method is known as written down value method. With the help of this problem, let us see the advantages and disadvantages of diminishing balance method. Advantages of diminishing balance method. First point is uniform effect on the profit and loss account. See the first year 2017-18. For first year, depreciation amount is 2000. First year 17-18 year depreciation amount is 2000. Second year 18-19 depreciation amount is 1800. Third year 19-20 depreciation amount is 1620. So year by year depreciation amounts are decreasing. On the other hand, when asset becomes older, so repair expenditure increases. In first year, as asset is new, there is no repair expenditure. But in second year, as asset became older, firm spent 200 rupees towards repairs. In third year, firm spent 380 rupees for repairs. Thus, year by year, annual depreciation amounts decrease and repair expenditure amounts increase. The decrease in depreciation amounts are offset by the increase in repair expenditure. As a result of that, you can see an uniform effect on the profit and loss account. Means what? See, depreciation is a loss. And to provide depreciation, every year we write depreciation account debtor to machine account entry. In first year, depreciation amount is 2000 now. So for 2000 we write depreciation account data to mission account 2000 entry. Here depreciation is a loss. Losses come under nominal accounts. Nominal accounts are temporary accounts. Therefore, at the end of the year, we should close these nominal accounts by transferring their balance to trading account or profit and loss account. Depreciation we should transfer to profit and loss account. So by transferring to P&L account, we should close depreciation account. How we open this account? By debiting, we open this account. How to close? By crediting that account. So the entry for transferring depreciation balance to profit and loss account is profit and loss account data to depreciation account. When we write this entry? At the end of first year, on 31st March 18, this entry has to be passed. Now, in profit and loss account of first year, we prepare final accounts at the end of the year, no? So, first year last date is 31st March 18. On that day, we prepare trading account, profit and loss account and balance sheet. So, in P&L account of this date, we should post that depreciation on debit side, because in journal entry P&L account is debited. So in first year, how much amount you are debiting to profit and loss account? 2000 rupees. Means 2000 burden you are putting on profit and loss account in first year. Come to second year. In second year, the entry for depreciation is depreciation account data to mission account. Second year depreciation amount 1800. So 1800 and in second year firm incurred repair charges also. Entry for repair expenditure is repair expenditure account data to cash account or bank account. Here this repair expenditure every year firm incurs. Means this expenditure repeats. As it is a recurring expenditure, it is a revenue expenditure. In case of revenue expenses, we should debit expenditure name. Suppose firm purchased a second-hand machine. To put that machine in usage, they spend some repair expenditure. This expenditure is incurred only for once, because second-hand machine we bring into usage only for one time now. In that case, that repair charges are to be treated as capital expenditure. Then what is the entry for that repair expenditure? Just like for installation charges, we should debit that repair charges to asset account. Then entry will be machinery account data to cash account or bank account. But this is not that type of repair. So when asset is used, it gets damaged and every year we have to spend some amount towards repair charges. As it is a recurring expenditure, it is a revenue expenditure and repair account is to be debited. Here repair expenses, also a nominal account, expenses and losses come under nominal accounts now. As this is a nominal account, we should close that account by transferring the balance to trading account or profit and loss account. Repair expenditure we debit to P&L account. Therefore, what is the entry in second year? Profit and loss account data to depreciation account. Depreciation amount in second year is 1800 now. 1800 rupees to repairs account 200 rupees. Now this entry we should post in P&L account, which is prepared on 31st March 19. Second year last date. When we are preparing profit and loss account, debit side to depreciation 1800 to repairs 200. But final effect is 2000 is debited to profit and loss account. In first year, we debited 2000 to profit and loss account. In second year also, we debited 2000 to profit and loss account. Come to third year. Third year depreciation entry is depreciation account debtor to machine account 1620. Third year repair expenditure entry is repairs account debtor to cash account 380. Now this depreciation and repair account both are to be closed by transferring their balances to profit and loss account. On 31st March 20, entry will be profit and loss account debtor to depreciation account, third year depreciation amount 1620, to repairs account, third year repair expenditure 380. In third year profit and loss account, which is prepared on 31st March 2020, we should debit to depreciation 1620, to repairs account 380. See the final effect? 1620 plus 380 becomes 2000 rupees. So in third year also, we debited 2000 rupees to P&L account. Thus, a uniform amount 2000 rupees every year it is debited to profit and loss account. You may get one doubt. What is the advantage in this? Advantage here is when uniform amount is debited to P&L account, it doesn't affect the profitability. For example, in first year we are showing 10,000 rupees as expenditure. In second year, assume that expenditure is 20,000. In third year, expenditure amount is 50,000. Year after year, if you show more and more expenses, the profitability of that firm decreases year after year. When expenditure increases, profit decreases. When profit is decreasing year by year, it gives a negative impression on firm's performance. Banks hesitate to give loans to them. Investors hesitate to invest in that firm. As uniform amount is debited to profit and loss account, firm can relieve from this type of negative impressions. Now let us see the second advantage. Second advantage is recognized by income tax authorities. If you provide annual depreciations under diminishing balance method, and if you claim that depreciation loss for tax purpose, then income tax authorities will accept that claim. Third advantage is easy to calculate depreciation on additions. For example, in second year, assume that on 1/4/18 firm purchased additional asset. Then to bank 10,000 debit side. While calculating the depreciation on credit side, we need not to calculate depreciation on two assets separately because both are used for 12 months in second year. So we can add opening balance of first asset and the cost of second asset. Then directly on 28,000 we can provide the depreciation. In third year also, assume that they purchased 5,000 worth asset on 1/4/19. This is the opening balance of two assets now, and this is third asset. Then you need not to provide the depreciation separately on three assets in inner column. Add all amounts. Opening balance of first two assets plus cost of third asset. Then total becomes 30,200. Directly on that value we can provide the depreciation. Thus, if any additions are made to the asset, it becomes easy to calculate the depreciation. But remember one point, when this advantage we can read, when asset is purchased on the starting date of the year. Suppose in second year, asset is purchased on 1/10/18. Then you cannot do like this because first asset is used for 12 months but second asset is used from October to March. October, November, December, January, February, March, only for 6 months. In that case, compulsory we have to provide the depreciation separately. So on first asset, 18,000 into 10%, on second asset, 10,000 into 10% into 6 by 12 because only for 6 months we used. In inner column, two values come, add them and write down the total depreciation in outer column. Fourth advantage is minimizes the risk of obsolescence. Obsolescence means what? For example, we purchased one machine for 50,000 rupees in 2001 year and we are expecting that we can use that asset till 2010. But due to latest technology, in 2004, we had to terminate this asset. Even though it is in good condition, we stopped using that asset because it became outdated. We replaced this asset in 2004 with a new one. Here, this existing asset value suddenly decreased, The reason is due to technology. Asset became useless. This reason is known as obsolescence. If any asset is exposed to obsolescence problem, it is advisable to provide the depreciation on that particular asset under a diminishing balance method. What is the reason behind that? Let us see. Suppose one asset is purchased for 70,000 rupees and the estimated life of that asset is 7 years. Under fixed installment method, how depreciation will be calculated? Cost of the asset is allocated throughout its life. 70,000 divided by 7 is equal to 10,000. So every year 10,000 will be provided as a depreciation. Assume that firm provided 3 years depreciation. So 3 years into 10,000 per annum, 30,000 depreciation firm has provided on this asset. And in 4th year, asset became obsolete. It became outdated. It is replaced with a new asset. Now, this existing asset cost is 70,000 rupees, but only 30,000 out of that is written off in the form of depreciation. So, if fixed installment method is used, firm fails to write off complete asset cost if there is any obsolescence risk. For same asset, instead of fixed installment method, if diminishing balance method is used to provide the depreciation, what is the advantage? Let us see. Comparing to fixed installment method, in case of diminishing balance method, the rate of depreciation will be more. Why? I will explain the reason in disadvantages, third point. So as per this accelerated rate of depreciation, assume in first year depreciation amount is 20,000. In second year depreciation amount is 16,000. Then by the end of second year, how much amount is written off in the form of depreciation? First year 20,000 plus second year 16,000, total 36,000. In third year, depreciation amount is assumed 14,000 rupees. Then 36,000 plus 14,000, total depreciation up to third year is 50,000 rupees. Say in fourth year, asset became obsolete, became useless. Even though from 70,000, 50,000 is written off towards depreciation. In case of fixed installment method, only 30,000 firm can return off. But here, 50,000 we can return off. So, the loss due to this obsolescence risk is less in diminishing balance method when you compare with fixed installment method. In fixed installment method, the unwritten portion That is 70,000 minus 30,000, 40,000 is lost to the company. Whereas in case of diminishing balance method, the unwritten portion is cost of the asset 70,000 minus 50,000, 20,000. So comparing to fixed installment method, loss is less. Last advantage is tax postponement. Diminishing balance method is useful to new firms because new firms generally cannot pay higher taxes in earlier years, because in earlier years they have to establish their unit in a full-fledged manner. They have to purchase machinery, they have to expand their business, they have to spend more money on marketing. So they try to minimize the tax burden. For them, diminishing balance method is advisable, because in case of diminishing balance method, higher amounts of depreciations are provided in earlier stages. When depreciation amount is more, that year profit will get reduced. When profit is less, tax burden will be less. They cannot escape from payment of taxes. They can only postpone that liability. So for new firms who wants to postpone the tax burden to later years, diminishing balance method is suitable. And same point becomes one disadvantage also. In starting years, it is advantage. We can postpone the tax burden. But in later years, it becomes difficult to pay high taxes. Year by year, depreciation amounts decrease. Then, year by year, profit increases, tax burden also increases. First disadvantage is uniform effect on the profit and loss account is not possible. Recollect first point of advantages. There we learn that under this method we can have a uniform effect on the profit and loss account. Theoretically it looks good, but practically it is not possible because of two reasons. Sometimes firm may provide less percentage of depreciation. For example, instead of 10%, if firm provided 5% depreciation on fixed asset, then first year depreciation becomes 1000 rupees, second year depreciation 950, and third year depreciation 903. What is the net effect on profit and loss account? Let us see. Repair expenditure remains same. First year there is no repair expenditure, but depreciation loss is 1000 rupee. So on 31st March 2018, we debit to depreciation 1000 rupees. We are putting 1000 rupee burden on P&L account. Come to second year. In second year, depreciation amount is 950 and repair expenditure 200. Second year, on 31st March 2019, depreciation amount is 950 and a repair expenditure is 200. Then how much amount you are debited to P&L account? Not 1000, 1150 we are debited. Come to third year, depreciation amount 903 and a repair expenditure 380. On 31st March 2020, depreciation 903 and a repair expenditure 380. Then total becomes 1283. Are you debiting same amount, uniform amount to P&L account every year? No. This is first reason. Second reason is, if repair expenditure increases when asset becomes older, then also you cannot put equal burden on P&L account every year. For example, second year repair expenditure 300 and third year repair expenditure 580. Then what is the effect on profit and loss account? First year depreciation amount 2000. There is no repair expenditure. First year on 31st March 2018, depreciation 2000 will be debited to profit and loss account. No repair charges. So first year burden on P&L account is 2000 rupees. Second year depreciation 1800 on 31st March 2019, depreciation 1800 and repair expenditure is 300. So total burden on P&L account is 2100. Third year on 31st March 2020, depreciation amount 1620 and repair charges 580. Then total burden is 2200. In this case also, you cannot put a uniform burden to P&L account every year. So when rate of depreciation is wrongly taken or when repair charges exceeds our expectation, in these two cases, you cannot maintain uniform effect on the profit and loss account. Second disadvantage is difficulty in calculation. This is the formula to calculate rate of depreciation under diminishing balance method. 1 minus n root of scrap value by cost of the asset into 100. N means estimated life of the asset. Scrap value means when asset is totally damaged. If we sell that asset on scrap basis, the amount which we are going to earn will be estimated well in advance. That income is known as scrap value. In question, rate of depreciation is given as 10% now. It is derived by using this formula. Can you calculate rate of depreciation if there is no scrap value for the asset? You cannot calculate now. So that is a problem in diminishing balance method. If asset doesn't have any scrap value, then we cannot apply this method to provide the depreciation on that asset. Third disadvantage is asset value cannot be brought down to zero or scrap value. Take fixed installment method. If cost of the asset is 20,000 and expected life of the asset is 5 years, then annual depreciation becomes 4,000 rupees. Then if this is asset account, then first year cost 20,000, first year depreciation 4,000, balance carried down 16,000. Second year, if you bring that 16,000 balance on debit side, credit side depreciation 4,000, balance carried down 12,000. Third year, depreciation 4,000, balance carried down 8,000. Fourth year, depreciation 4,000, balance carried down 4,000. Come to last year, credit side balance carried down, you should bring on debit side. To balance brought down 4,000. And in fifth year, credit side by depreciation 4,000. Is there any balance in account at the end of the year? No. So debit side, credit side amounts are same. Means account is closed. The balance in account came to 0. Suppose there is some scrap value. Then what happens under fixed installment method? Let us see. Suppose scrap value is 2000. Then annual depreciation under fixed installment method is cost minus scrap value divided by estimated life is equal to 3600. Then first year depreciation is 3600, 20,000 minus 3600, balance carried on is 16,400. Second year depreciation 3600, 16,400 minus 3,600, balance carried down 12,800. Third year balance carried down 9,200. Fourth year balance carried down 5,600. Fourth year balance carried down, we should bring on debit side of fifth year now. To balance brought down 5,600. Fifth year depreciation 3,600 and 5,600 minus 3,600 is equal 2,000. The 2,000 is what? Scrap value of the asset. Asset is totally damaged. We sold it in market. We got 2,000 rupees. So bank account debtor to machine account. Credit side by bank 2,000. Here also debit and credit totals became same. So under fixed installment method, we can properly close the account. we can bring that account balance either to 0 or its scrap value. But it is not possible under diminishing balance method. I am continuing this account for more 2 years also. Total for 5 years I am preparing this account because estimated life of this asset is 5 years. Then every year 10% depreciation we should calculate now. Up to 3 years already explained. Come to 4th year, on opening balance 10% if you calculate, at the end of 4th year depreciation becomes 1458. Then debit total minus credit total, balance carried down is 13,122. Bring that amount to 5th year starting date. On this amount if you calculate depreciation, then depreciation value becomes 1312. Then debit total minus credit total is equal to 11,810. And this is balance carried down. This is end of 5th year now. By this date, asset account should get closed. Means how much amount we have on debit side, credit side also we should have the same amount. In fixed installment method, we can bring that asset account in that manner. But here it is not possible because whatever is the value on debit side, in that only 10% we are providing as depreciation on credit side. So 90% balance will be there now. Whatever may be the amount here, out of that only 10% we are crediting. So compulsory remaining 90% appears as balance carried down. Actually speaking, 5 years completed, asset became useless. Now we have to purchase another asset. But according to accounts, at the end of 5th year, we have 11,810 worth property. Is it correct? No. Thus, we cannot bring the value of asset to 0 or scrap value at the end of its life. Then what to be done? At least, if you charge more percentage of depreciation, we can bring this value to a lesser amount. Means, we can minimize this disadvantage up to some extent. For example, suppose instead of taking 10% as rate of depreciation, we are taking 80% rate of depreciation per annum. Then what happens to asset account? Let us see. First year depreciation is 80% on 20,000, 16,000. Then balance carried down 4,000. Bring that to second year. Second year depreciation on 4,000, 80%, that is 3,200. Balance carried down is 800. In third year, balance carried down is 160. In fourth year, balance carried down 32. In fifth year, balance carried down 5 rupees. Asset life is 5 years now. So at the end of fifth year, exactly speaking, asset account should get closed. The balance should come to 0 or at least to scrap value. But here asset account is not closed, it is showing a balance of 5 rupees. Even though we can stop doing this account because asset is totally damaged and asset account is showing only 5 rupees balance, a negligible balance. We know that under diminishing balance method, we cannot close the account properly. As it is negligible amount, we will leave here. But is it correct to provide 80% rate of depreciation annually? Conceptually, it is wrong, no? When you use 20,000 worth asset, in first year only, will the depreciation be 60,000? It is not correct, no? Depreciation value slowly reduces. And if you provide depreciation in this manner, it affects firm's goodwill. Because in first year, as depreciation loss is more, it affects the profitability. When you show more loss to P&L account, that year profit will get reduced. So definitely, comparing to fixed installment method, more percentage of depreciation we have to provide if it is diminishing balance method. But you cannot provide 80%, 60% depreciations on assets. Under fixed installment method, if you select 10% as rate of depreciation, under diminishing balance method, you may provide 20% or above 15%. Then only within a short period, you can close the account in a proper manner. If you provide less percentage of depreciation, it takes a long time to write off the asset properly. So total asset value you cannot write off in the form of depreciation. So remember, in case of diminishing balance method, comparing to fixed installment method, rate of depreciation will be more. Then only we can close the asset account properly within a short period. Fourth disadvantage is doesn't provide funds to replace the asset. See, depreciation is non-cash expenditure like salary, rent, postage. We need not to pay these depreciation amounts to any outside person. We keep that amount aside in the firm only. But that depreciation amounts are not going to be invested in any securities. We keep that amount aside and we use that amount to meet day-to-day expenses like to purchase raw materials, to pay building rent, for petrol expenses. When we use these depreciation amounts to meet day-to-day expenses, when asset becomes damaged, it is very difficult to replace the asset because there is no proper planning, there is no proper savings to replace the asset. Fifth disadvantage is no interest income. As depreciation amounts are not invested in outside securities, as these amounts are kept in the business unproductively, firm cannot earn any interest on these depreciation amounts. Sixth disadvantage is if depreciation is provided under diminishing balance method, if any additions are made to the asset, it is very difficult to value the individual asset. Recollect third point of advantages. There we learned that if additional asset is purchased, it becomes easy to calculate the depreciation. But other side of the coin is it is easy to calculate annual depreciation, but it is very difficult to know the value of individual asset. For example, this is fourth year starting date now. On this date, I want to know the value of second asset. Second asset is purchased on 1/4/18 for 10,000 rupees. In this opening balance, three assets values are there now. I want to know only the opening balance of second asset in this value. Then separately we have to calculate second asset cost 10,000 into second year on second asset at the rate of 10% depreciation becomes 1,000. Then balance carried down 9,000. Bring that to third year. Opening balance of second asset is 9,000. On that 10% becomes 900. Then balance carried down is 8,100. So on this date, in this 27,180, the opening balance of second asset is 8,100. Thus, if you want to know the value of any individual asset, then separate calculations are needed, which is difficult. Now let us see for which type of assets diminishing balance method is suitable. First point is heavy repairs. This method is suitable to the assets that require heavy repair charges as they become older. Because in diminishing balance method, depreciation amounts decrease year by year. On the other hand, repair expenditure amounts increase year by year. So the decrease in depreciation amounts are offset by the increase in repair expenditure. As a result of that, uniform burden can be given to profit and loss account. Second one, this method is suitable to the assets that require frequent additions. Whenever additions are made to the existing asset, we need not to separately compute the depreciation on these additions. So on total value, only for one time if you provide depreciation, that is enough. Then this method is suitable to the assets which have a long life, because in short term it is very difficult to write off complete depreciation by providing more depreciation in starting years. For example, asset value is 1 lakh rupees and the life of the asset is only 3 years. Means within 3 years, firm has to write off total 1 lakh rupees. And in diminishing balance method, earlier depreciation amount should be more than the later year depreciations, no? Means maximum amount of this 1 lakh rupee is to be provided in the form of depreciation in starting years only. Then it affects starting years profitability. When you show more amount towards depreciation, that year profit will get reduced, which gives a negative impression on firm's performance. So for short life assets, this method is not suitable. Then obsolescence. If any asset is exposed to obsolescence risk, providing the depreciation under diminishing balance method is advisable, because in diminishing balance method, maximum portion of that asset will be written off in earlier stages only. So after some years, even though asset becomes useless because of obsolescence reason, the loss will be minimum. So this is all about 11th problem and the meaning, advantages, disadvantages and suitability of diminishing balance method. Hope this video is helpful to you. Thank you.